The following is brought to you by goldseekmint.com. Silver and gold bullion directly from the mint. goldseekmint.com.
Welcome to Cambridge House Live. I'm Vanessa Collette here at the Sprott Symposium, and I'm pleased to have Adrian Day, the founder of Adrian Day Asset Management, with us. It's great to see you again, Adrian.
Well, and you, Vanessa, thank you.
Now, Adrian, you've been somewhat critical in the past of the Fed's small reductions in QE. What do you make of Yellen's statements that they're going to be ending QE by the end of the year?
I don't see that happening, or at the very minimum, let's put it this way, I don't see any meaningful tightening anytime soon. And, you know, from the point of view of gold, which is what we're concerned with, the gold market was, of course, spooked when Yellen talks about the end of QE. But let's not forget that even if QE does end, we still have an extremely accommodative monetary policy. We have interest rates at 0.5%, negative real interest rates. This is still a very, very easy policy. And I don't think we're going to see any tightening. I think the Fed has boxed itself into a corner. And, you know, they get spooked by any negative economic news. So I'm still quite sanguine about monetary policy from the point of view of gold.
Right. Now, do you think they would retract any of what they've done so far? Or?
No. But remember, we've had 4 QEs so far. You know, right. QE 1, 2, 3, 4. Each one's been a little bit different. So maybe they won't retract what they've done, but they'll just do something different next time. And let's not forget, we're talking about this 10 billion a month that they're reducing QE, but let's not forget that this was an additional 85 billion that they added on only towards the end of last year. So we're only talking about reducing what they added on.
Right.
We're not talking about any real tightening.
I see. Now, even with QE happening, the U.S. has a huge amount of debt. How is the U.S. going to be able to repay this debt?
I think you've hit on the central question. This is the reason I think interest rates are going to stay low and stay low for a very long time. It's not just the absolute amount of debt, but of course it's the debt service. Right now, U.S. debt serving for the federal government, debt service is about 14% of federal revenue. We've been higher than that before. That's a high number, but we have been higher before. But let's not forget, that's at a point when interest rates are at 70-year lows, when the amount of money that goes to debt servicing should be much lower. So if interest rates today, the federal government today is paying about 2% on average on all of its outstanding debt. Over the last 25 years, the average has been about 6.5%. So if we move back even halfway towards the 25-year average, the U.S. will be paying 30 and 35% of its revenue on debt service. That's unsustainable. That's worse than Greece, worse than Italy, worse than Ireland. So I don't think rates can go up.
So are we going towards a devaluation or a default?
I don't think you're going to see the U.S. default in a technical sense. I don't think, I'm not that extreme. But I do think what you are going to see is the U.S. is going to deliberately manipulate rates to a low point, and the dollar is going to decline and decline steadily. I'm not looking for a dollar crash. It's just going to decline and continue to decline steadily over a number of years. And so that they'll pay the debt back, but they'll pay it back in dollars that are worth less than existing dollars.
Right, so a gradual managed devaluation.
Exactly. And, you know, evidence of that, you look at what happened earlier this year in Ukraine, and what happened to the dollar? You'd expect the dollar to go up on a geopolitical situation. The dollar actually went down against the euro. That is a very telling sign if the dollar can't rally on news like that.
Well, the Fed's been saying that they're reducing QE because employment numbers are looking so good. What's your take on that?
Well, there's no question that employment numbers are better than they were. No question. But for a recession that a recovery rather, that's now 6 years old or 5 years old, this is a very, very tepid recovery from a historical point of view. And of course we all know, or in the US, I'm sure in Canada they know too, you know, but in the US everybody knows that the headline number is really only telling you half the story. Do you know over half over half of the new jobs created this year have been part-time jobs.
Right.
Now, that's fine. A part-time job's better than no job.
Right.
But to be talking about 180,000 new jobs created when the US economy needs over 220,000 new jobs each and every month just to stay where it is because of new people entering the employment pool. I'll throw something else at you, if I may. On a long-term basis, there are fewer people in the United States, in absolute numbers, fewer people employed full-time in non-government positions today than there were in 2003. And that's despite a huge increase in the employment pool, both people entering the employment age and immigrants coming into the country. So no, I think there are fundamental problems in the US economy.
Now moving over to gold demand, you've said that some of these claims about the buying in China dropping are overblown. What are you seeing there?
Yeah, again, we've had, I think it goes along with, in a way, what I was saying about the Fed tightening. It's a reality, but people exaggerated the reality and exaggerated and overreacted. And so you've seen China's gold buying, as evidenced by Hong Kong exports, the exports of gold from Hong Kong into China. No question, they've gone down this year for the first 4 months. We don't have June's numbers yet. So for the first 5 months, they've gone down. But remember, that's going down over last year, which saw an incredible increase. So the amount of gold buying in China is still going up. It's just going up at a slower pace. So I think people have overreacted, I really do.
Now, what does this all mean for gold? Where do you see gold going next?
I'm quite bullish on gold. Now, and I'm bullish for the monetary factor, for the geopolitical reasons, and we talked about the Fed a lot, but we didn't talk about other countries. Every country around the world is pursuing a stimulative monetary policy right now. Japan has pledged to double their money supply in 18 months. I'll repeat that. Double their money supply in 18 months. That's a deliberate policy of the government. In Europe, interest rates are now negative throughout the whole of Europe. So we're seeing negative real interest rates throughout Europe. So every country around the world pretty much is pursuing stimulative monetary policy. That's very positive for gold. And the negatives for gold, such as China, such as fear of tightening, have been exaggerated on the downside, I think. Now, I'll say two things. One is when you have a market such as gold that declines by, the amount is declined and the gold stock's declining by 70 and 80%, and they do it over a 3-year period, it's going to take time to recover. It will be unrealistic to expect a sharp bounce back from that kind of long decline. The other thing I will say, however, is that people are gold is very underowned right now. Let's just say in the spring of this year, we had gold sentiment indexes at their 10-year lows. 10-year lows, that doesn't make sense with gold at 1,300. And you've got hedge funds that are out of gold, you've got generalist funds. Generalist funds don't own any gold right now. So gold is very unloved and underowned. That means it has the potential to move quite dramatically at some point.
So what are you doing with your fund right now, and how are you advising your clients? Are you advising them to get into gold stocks? What's the strategy?
Yeah, absolutely. All of our accounts are discretionary accounts, so we have discretion. And we are fully loaded on gold. If we have a gold account, there's no cash. And if we have a generalist fund, we have our full allocation of gold. Right. Absolutely. And that's both some of the seniors, but also some of the juniors and some of the exploration companies.
Where do you see us in this cycle right now?
Where do I see? I think we've just been through a mid-cycle correction.
Okay.
And, mid-cycle corrections in long bull markets are typical. And we only have to think back to the last gold bull market in the 70s. Gold fell almost 50% from 75 to 76, almost 50%. A lot of people thought the bull market was over. But of course, from $100 up to $850 was a pretty good move. So I'm not saying we're going to see a repeat of that, but I certainly think what we've just seen is a mid-cycle correction, and frankly a typical mid-cycle correction. Gold was only down 40%. that's not a lot. I mean, that's not extraordinary compared with other long cycles. You look at Japanese stocks in the 80s, you look at tech stocks in the 90s, they all had mid-cycle corrections.
Well, Adrian, it was a pleasure having you on the show today. Thank you so much for joining us, and look forward to the next update.
Well, thank you very much. Appreciate it. Thank you.